David. Turning to the economy now, and we're being warned this morning inflation could surge past 7% and the price of oil could hit more than $200 a barrel. It's about double if the war in the Middle East continues to re-escalate. It comes as the federal government unveils plans for a new oil refinery in Western Australia in a bid to shore up Australia's future energy supply. John Blackburn, Chair of the Institute for Integrated Economic Research, joins us now. Good morning to you.
Good day.
7% inflation, a doubling of the oil price per barrel. Is that the worst case scenario? Where are we headed?
Regardless of what happens in the Strait in the next few months, we're heading for a couple of very difficult years that's largely out of our control. So oil prices have been kept contained because since March, IEA member countries have released 400 million barrels of strategic stocks into the market, and that's kept the price down. Those stocks run out in the next couple of weeks. So that is not there to keep prices contained.
So you're saying we're in for a difficult couple of years?
Yes. So let's just say the Strait stays closed for a few months, more months at least. We'll see the oil prices go up. The next problem is the Russian refineries have stopped exporting because Ukraine's been attacking them. We are not only subject to oil prices, there will be a global shortfall in refining capacity. And as strange as this sounds, we're the world's largest importer of refined diesel, such an important fuel. So you've got these two factors that will drive prices up. If the Strait magically opens, then it's going to take a couple of years to work through all the flow-on effects to get the Strait open, to get the refineries reconfigured. But here's the rub. Countries that release those 400 million barrels of strategic stocks will want to restock them. So we're not going back to normal demand after the Strait opens. We're going to go back to a higher demand. And that will drive prices up as well.
OK, let's look at solutions. WA is saying we're going to build an oil refinery. What do you think of that?
Look, it's a great start. For the last 15, 20 years, no government's been prepared to look at that. In fact, in 2015, the department told me we don't need any refineries. It's cheaper to import refined fuel. I nearly fell over when I heard that. So look, this will be a part of the solution, but it's not the solution. It's a very complicated mix, but we need to move in that direction.
Which government told you that?
That was under the Liberal government, but there was a department official, happened to be an economist, told me that, and I said, well, just in time is not just in case. OK,
so this WA solution, how fast could that happen?
Well, if you look at a refinery, what they're talking about there, of that sort of scale, it's probably 7 to 10 years before you'd actually have it running. But that's normal with the industry. It takes a lot of time to do changes to our supply chains. So for the short term, we're going to have to deal with the cost impact.
And put these in place for the long term.
Yeah. Okay. But again, what I'd say is this is not a case to panic because thankfully we now have fuel stocks. And what is not emphasised by the government is 80% of the world's supply is still there. And if we've got 40 days of diesel, for example, that would allow us to substitute that 20% loss for 3 months. This is not something that's going to fall apart next week.
OK, thank you. There's at least some good news.
Yes.
Thank you, John. Here's David.
Thank you.